there was an emergency meeting or a sideline meeting between John Williams, head of the New York Fed, and a whole bunch of representatives from different banks as to why they weren't utilizing the repo facility more. Yeah, the mainstream will follow whatever's hot. If Bitcoin's hot, they'll follow Bitcoin. If gold's hot, they'll follow gold. So there's no chiddush there. There's nothing new there. To me, what's happening now is that gold, it's not that gold is consolidating, it's that the dollar is taking a rest, because now we're at a breaking point where I think it's steady today, and gold stocks are diving because other stocks are diving, because Nvidia was a buy the rumor, sell the fact thing, and Bitcoin's diving, and that's probably causing margin calls in other places because people take out debt to buy Bitcoin. Who knows how much debt is stacked into Bitcoin? Nobody knows. So I think we're going to continue to be volatile until the Fed picks a direction. And I know which direction they're going to pick. So it's just a question of waiting it out. And as for the dollar price, I'm not even going to say what it doesn't even matter. The question isn't what the dollar price of gold is going to be. The question is, at what dollar price, where are we going to be when nobody with dollars will will be able to buy any gold, because nobody with gold will want any dollars. So what's that dollar number where everybody with gold just says, stop, I'm not taking any dollars, I'm just gonna use this stuff directly, and then gold becomes money again directly. What number is that? I mean, I would guess maybe somewhere around 80,000, 60,000, 80,000. I mean, it depends how much money the Fed prints. If the Fed stops printing, it'll stop at 100% now, which is about 30,000. But I know they're going to print more, so it could stop at 60,000. And then, it doesn't even make a difference, because the purchasing power is the same anyway, no matter what dollar number we end up at the end. So Japan is as perfect of an example as we can get for when Keynesianism breaks down, when there's an inflection point and it no longer works, right? The whole Keynesian system is dependent on higher interest rates. Means you strengthen the currency, means you slow down inflation. Like the way Walter Block, I remember, puts it, he says, Professor Walter Block of Loyola University, he's in the Mises Institute, or he was. He says that Keynesians believe the economy is like a car, right? You hit the brakes by raising interest rates, and you hit the gas by lowering interest rates. So that works as long as the main owner of your bonds, of your government's bonds, is not the central bank itself. So if let's say the main holders of the government's debt are private companies, or just anyone but the central bank, so if you raise interest rates, that would strengthen the currency, all other things being equal, because higher interest rates means higher savings rates, so that encourages people to save and spend less. If it encourages to spend less, that means prices will go down, because the demand for holding money itself, as opposed to spending money and getting rid of it for other things, goes up. So in that situation, you're strengthening your currency, you're raising interest rates, you're hitting the brake on the car. But in a situation like Japan, it's the inverse. Why is it the inverse? Because the biggest owner of Japanese government bonds is the central bank itself. So therefore, when you raise interest rates, what happens to the central bank? Its balance sheet loses value, because when you raise interest rates, you're pushing down the value of the bonds, and therefore your central bank goes into losses. But the currency is the liability unit of the central bank itself. So at that point, where Japan is right now, the higher interest rates go, the lower the yen goes. You can see this on a chart going back like 5 or 6 years from the point where the inflection point started. The yen has been falling as Japanese interest rates have risen. Not perfectly. It's not perfectly correlated, because you still have people and traders that are human that still believe in the Keynesian principle, but nature overwhelms it. So what I'm saying is, Japan can raise interest rates and therefore hurt its currency, because the biggest owner of the bond market is the issuer of the currency itself, or it can push interest rates down and hurt its currency even worse. There's no way up for it. It's over. It's done for Japan. It's just a matter of time now. And this Takaichi woman doesn't seem to get it, because she's really into Abenomics, where the balance sheet of Japan started to just go vertical, and she wants to do that and spend even more money that Japan doesn't have. I think her budget's supposed to be released on Friday, which is tomorrow. It might have already been released as you're watching this, and who knows what's going to happen to the yen then. Everybody's worried that that Japan is going to fall over. And let's not forget that they're not reproducing, just like Korea, just like most of the Asian countries. They're getting older and older, and that is the death of a civilization. The samurai would be weeping in their graves, and I feel bad for them. Anything could cause everything to fall over because everything is intertwined and everything is reliant on the debt of everything else. So, I mean, Japan happens to be like a big fulcrum point, a big point where people talk about the Japanese carry trade. You look it up, like how big is the Japanese carry trade, and people say like, oh, it's anywhere between 1 trillion and 20 trillion. We have no idea, depending on what you count. So like nobody knows here. We're talking about like a huge, like, like a galaxy collapsing in on itself of fiat money everywhere. I mean, we're in one singular fiat system, and there's no escape from it except for gold and silver, because the dollar is the base of every fiat currency, including the yen. The biggest asset besides Japanese government bonds for the Bank of Japan is dollars. That's why the dollar is the reserve currency. That's not just like a keyword. It means is the reserve currency. Every other central bank has dollars as a reserve for their own currency, which means we're all in the same system here. There's no when the dollar falls, everything goes with it. We don't know exactly what is the Jenga block that has to be taken away to have everything fall over. But Japan could be it, but it could be something even stupider. It could be something that nobody even knows exists. It could be Bitcoin. I don't know. There's a few things that I'm tracking. I always track the plumbing first, and then I see if it's affecting other things. So what I mean by the plumbing, those who have followed me probably know what I'm talking about. The interest rates, that is the basis of all other interest rates. That's the secured overnight financing rate, the rate at which banks charge each other to loan cash in exchange for treasuries overnight. That's it's heading higher and higher and high. It's drifting higher, even higher on some days than the Fed's upper limit on the Fed funds rate. The Fed funds rate is like a different thing. It's a very minor market. It doesn't even matter anymore. It's like the volume there is like $100 billion a day at most, whereas the secured overnight financing market is like over $3 trillion. So the largest volume has been 3.2 trillion. And it keeps going up, the volume, which means more and more and more banks need money overnight for whatever reasons it is. I mean, it's probably a lot of the bank's clients are engaged in some kind of basis trade on whatever treasuries, and it keeps getting bigger and bigger. And if they can't provide the dollars, then those trades have to close. But basically, the Fed is in a bind now because eventually this is going to lock up pretty soon. I thought it was going to lock up already because there's less than $3.2 trillion in bank reserves out there, but apparently you can go above that. I don't know how much farther you can